And joining me for a closer look on what's playing itself out in that market scene is Jaco Eagar from Rand Swiss. Jaco, a pleasure. Good afternoon to you.
Good afternoon. Good to be here.
Fantastic, Jaco. We are seeing a rather bleak one, I think, on the JSE. Better screens in Europe. I'm keen to get your thoughts on what markets are digesting today. We did see that US inflation print, I think, and also just wondering, what is driving this downbeat performance after, I think, a decent day yesterday.
Apologies, I missed some of it, but let me dive into what we see. I think you would have noticed quite a few big numbers coming out of the US later today. You may have mentioned PPI, retail sales, jobless claims, all kind of telling us or trying to what we kind of want to digest and see what's going to happen in terms of the rate announcements. So next week, I think it starts on Wednesday. We have the Fed meetings, and then all of these data points will obviously feed into what we can expect with rates around rates. Now, as you know well, we've been beating this drum around rates and when it will cut and exactly when we will see these changes happening. So we look keenly towards that coming out next week. I had a look on the Reuters forecasts, and out of 108 analysts polled, 108 says we're going to stay flat next, from the next meeting next week. So don't expect too much from a cut in this one. 100% reckon we will stay the same. However, from a forward-looking perspective, if we kind of go out to June, which it's mid-June, we see about a 65% poll, so 65% chance of a cut. It looks like we can expect a 25 basis point cut. And then just maybe out of interest, if we look a little bit further out, kind of towards the end of the year, the question is always, when's the first one? But what is the trajectory towards the end of the year? Now, for interest's sake, the amount or the percentage of guys thinking that we will be at the current 525 to 550 range. In terms of the US inflation is 0.7%. Wow. So, less than 1% we'll be where we are today. So I think that's a clear indication that there will be some cuts coming through. How deep? Good question. We look at the current kind of estimates, about 34% shows roughly a 1%, 75 basis points, cut towards the end of the year in total, of course. And then it gets a little bit higher and a little bit lower, but overall I think the consensus will lie, or the bell curve will lie around 75 basis points from here towards the December meeting.
Very, very, I think, interesting trajectory we have ahead of us, Jaco. All of us anticipating those cuts and as soon as possible. Keen to get into some company news with you now, maybe starting off with the big one for the day, which I will say is Standard Bank. They really have, I think, released a stellar set of numbers. Of course, maybe on the upward side of those credit losses and that ratio really reflecting that. But I think the ability to eke out the growth that they have, and even from the rest of their Africa operations, is something certainly worth mentioning.
Yeah, absolutely. I think, as you say, I think stellar is exactly the correct word to use. It's a good set of numbers. Not much you can find fault from then obviously a historic point of view. So you have to ask the question, why is the stock trading down so handsomely today? At least the last time I checked. I don't know if it's recovered within the last kind of hour or so. But yes, good set of numbers. It shows we had in a high inflationary environment, that net interest income numbers come through to the bottom line. I think we'll see it in all the banks from that perspective at least. So we have to ask what are the challenges, and then we can drill deeper into it. But I think that the gist of it is the underlying consumer is hurting, and I heard you mentioning the number already, or the phrase already, but the credit loss ratio, at least from a Standard Bank point of view, and we we kind of saw impairments and these things cropping up in the APSA numbers a day or two ago as well. But the credit loss ratio is now getting higher, and it's kind of heading towards the upper level of the target range. That's on the one side, if we had to go and look for the negatives. And obviously the other side is there's about, I think 50, between 40 and 50% of the Standard Bank earnings that we earn, outside of South Africa, but still in Africa. And they highlighted that the one of the big kind of headwinds is of course the currency and the currency depreciation and volatility, etc. So we know in South Africa that's already a problem, but can you now imagine in the rest of Africa, Ghana, Kenya, Mozambique, Nigeria, where Standard Bank also have operations, that kind of takes that same headwind and kind of makes it a little bit stronger. So those two things, I think, if we had to go and look at the negatives that we had to pull out of the report, is probably why we're seeing a little bit of a more red number on screens at the moment. But yeah, apart from that, historical number, the last 6 months, a very good set of numbers.
Well, Jaco, we don't have much time left. I'm actually keen to get into your stock pick. But first, I'd like us to reflect on counters that have found favor with your industry peers.
Oracle's results came out yesterday. They were superb. And why I like Oracle is it's been like a forgotten artificial intelligence play. It's a massive software company. And I think what impressed me is their guidance, what they see out there in expanding their whole cloud services. And I say it because we've ignored this company. It's done well, but it's never amongst our Magnificent Seven and so on. So have a look at those numbers. I think where they're projecting, where their projections are very encouraging for the next couple of years. And this is not a small business. It's a highly rated business as well.
The valuation is just quite compelling. I know the share price has gone up a bit recently, so it certainly hasn't been a bad share price. But 6% dividend yield is still very attractive. And if your earnings are going 50%, that's an historic dividend yield. The dividends are going to go up as well very nicely. So I just go for this on a valuation basis. Obviously, that's undergone management changes over the last couple of years, but that all seems to be for the good.
I think I'll go long the Chinese market and I'll buy the Citrix, the CHN, But I think the Chinese market, they've got some serious good valuations for the fact that they've just been down. And we know that we've got issues when it comes to the property market, which accounts for almost 80% of that economy. But you look into that index, it's mainly tech stocks. And we know the guys were harsh at some point when it comes to tech stocks. I'm saying the Chinese government cannot afford to have issues with the property market and then start impeaching pain on themselves by being harsh again when it comes to the IT market. I expect some rebound from that end.
Keen to get your thoughts on one or two of those, Jaco. Do you like any of them? Oracle, Momentum Metropolitan, as well as the Satrix MSCI China Feed ETF?
Yeah, look, not much not to like there. I think Dave said he's a forgotten AI play in Oracle. Interestingly enough, in our AI portfolio, we have Oracle as well. So definitely one we like, not just on the back of these numbers, but it has been part of the portfolio for, probably about a year. And definitely agree with him. The China one is obviously, always a interesting one. And we have that debate, and it's quite a rigorous one that we have, quite often, because we have this kind of political problems in China that keeps cropping up, and we have to think about them and translate them into risk versus return. So the risk remains, and if you look at the riskier side of your asset allocation spectrum, I agree. I think there's a place for China. I probably won't pick the specific ETF that he's mentioning. There's maybe one or two other ways I'd like to play it, but I think you have to include a bit of China in the riskier part of your portfolio. Why? GDP growth has been positive. Equity market performance has been negative. There's this dichotomy or this distinction that's kind of happening between the other markets and China. They're at all-time lows, other markets at all-time highs. The PE is 64% cheaper than the S&P 500, 70% cheaper than Japan, etc. So I think there are definitely pockets of kind of excellence, or even if it just normalizes to some extent, there's a lot of scope there. So yeah, don't put your everything you have into that, but your retirement money. But absolutely, I think there's a bit of a space for a bit of a China play at the riskier end of your portfolio.
We have about 20 seconds left. Keen to get what counter you're liking today.
I am, we've already spoken about Standard Bank. Our pick is FirstRand, so I'm going to go with FirstRand today. Couple of reasons. I've already mentioned in the Standard Bank portion that the net interest income in a high interest rate environment is obviously a positive. We think it's best of breed, in our opinion, in the South African banking environment. They say a kind of leader in non-interest revenue. They're well capitalized. We think they're cheap in terms of international peers. And then just maybe more technically, year to date down 12% already. Looks like it's consolidating a bit at these levels, so probably not a bad entry point for, I think, a sector that should see a reasonable 2024.
Fantastic, Jaco. A pleasure having you today on Business Lunch. Thank you for your time. That was Jaco Eagar from Rand Swiss.